Welcome to the 3 Edge Week in Review for the week of February 8th. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge, and I'm pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Today, along with a brief update on the global capital markets, Steve and I will be discussing real assets such as commodities and gold, and we will even discuss Bitcoin and its potential role as a form of digital gold. But before we get to this, let's take a look at what happened this week in the global capital markets. And once again, this week we saw the S&P 500 index reach yet another new all-time record high, as equity markets continue to be bolstered by what is referred to as the reflation trade, a combination of continued monetary stimulus from the Fed, the potential for additional fiscal stimulus in the form of a major coronavirus relief package, and a recent pickup in the rollout of coronavirus vaccines, along with President Biden's announcement recently that the U.S. has now secured agreements for 200 million more doses of coronavirus vaccine. So investors are encouraged that this powerful combination of monetary and fiscal stimulus and a ramping up of coronavirus vaccinations will be enough to create the bridge, if you will, to the other side of the coronavirus global pandemic and an economic rebound in the second half of 2021. A risk to the reflation trade includes the emergence of and the spread of any new virus variants, which could threaten and extend lockdowns and delay full-scale economic recovery. So let's move on to our topic for today's video, and we'll talk about real assets. And there are many forms of real assets, but today we're going to focus on commodities and gold. And broadly speaking, when we talk about investing in commodities at 3Edge, we're referring to index ETFs that invest in a diversified basket of different commodities. Could include crude oil, food, agriculture, grains, livestock, timber, precious metals, industrial metals such as copper and platinum. So Steve, why don't we start by having you first describe what are the conditions that are most conducive to investing in real assets?
Well, Fritz, as we've discussed often, the markets move in cycles, and a very important cycle to track to know if it's a good time to be in real assets is the cycle of real interest rates. And by real interest rates, I mean inflation adjusted, or the difference between the interest rate you get from investing in a bond and the expected inflation rate. And as one might imagine, if real interest rates are high, that means that when you buy a bond or when you put your money in cash, you're getting an interest rate that's well higher than the inflation rate. And that's a good deal. And you're making real wealth. And that's usually when real assets do not do very well, because real assets do not generate interest. But on the other hand, when you have the part of the cycle where real interest rates are very low or negative, that's very conducive to real assets, because when you invest that money in a bond or in cash, you're not even keeping up with expected inflation. And that's typically when real assets do well.
Excellent. So as we know, real assets represent one of the major asset class groups that we model. And then within real assets, we distinguish between commodities and gold. So to be a bit more specific, what would be conditions that would be more conducive to favoring gold, and what conditions would be conducive to favoring commodities?
Well, Fritz, because gold and commodities are both in the category we call real assets, they both benefit from negative real interest rates or falling real interest rates. We know that. And that usually happens when the Federal Reserve Board is trying to stimulate the economy and they make money much more plentiful, they bring interest rates down, et cetera. The difference between gold and commodities is that gold is more of a pure, what we call anti-paper money. It's more of a pure hedge. We think of it as an alternate currency. But the difference between paper money and gold, the biggest difference is that with paper money, central banks like the Federal Reserve Board can decide to just print lots more of it at a given time, like they've done over the past several months. Whereas with gold, unlike most commodities and unlike paper money, the supply of gold only goes up a very, very small amount compared to all the gold that already exists. So that's why it's considered a store of wealth. And so when monetary policy gets easy, the first category of real assets that does well is gold. Then, with a time lag, that monetary stimulus after a period of time, starts to work through the economy. And when investors start to believe that economic growth is going to improve, that's when commodities do well, because commodities, unlike gold, are much more tied to real economic activity. And as you mentioned earlier, we've got a situation where not only are the vaccines now coming on stream and people are getting more optimistic about getting to the other side of the coronavirus, we have a situation where there's a massive fiscal stimulus plan that's in Congress right now that could be passed quite soon, and that's expected to add to growth in the real economy. And then beyond that, there's talk about major infrastructure plan, which will also be a tremendous amount of capital, not just inflating the monetary policy, but actually going back into the real economy. And that's when commodities can do well. If you look at this chart, I'd like to show you, back to the discussion of cycles, how we have had some major cycles in commodities. And as you can see, this is looking at the commodity index relative to the stock market index, in this case, the S&P 500 index of US stocks. And what you find is that not only can commodities act as a nice hedge against the stock market, because many times when the stock market has done badly, commodities have done very well, but that over these cycles, and this goes back to 1971, we are now in an extraordinary period where commodities have never underperformed stocks more than they have now. And as we can see from these cycles, they don't go one direction forever and ever. They tend to come back and mean revert. So we think that this is an excellent time to invest in commodities, not only because there are signs that the economy will respond to all this fiscal stimulus, but also because it's relatively undervalued compared to equities to an extreme. So you can consider the downside is quite limited, but the upside is quite high.
Excellent. So now let's turn our attention to a hot topic in terms of the financial news and just the news in general, and that's to take a look at Bitcoin or cryptocurrencies. And as you described, we look at gold as an alternative form of money, different than fiat currency. So the question then could be, is Bitcoin going to be yet another form of money, another form of currency in the future? What are your thoughts about that?
So our interest in Bitcoin is unlike many others who just see an opportunity to make a fast trade or jump on a trend in and out. That's not at all our interest. Our interest is to consider the possibility that Bitcoin might act like gold, might be another way to store wealth, where the supply of Bitcoin, much like the supply of gold, is very constrained and growing very slowly, unlike paper money. And the extent to which people who would otherwise invest in gold for the same reasons we do, as a hedge against paper money printing, might take some of that money and divert it into Bitcoin. Therefore, almost as a defensive posture, we need to understand what Bitcoin is all about, and we need to potentially diversify our gold holdings and think of gold as physical gold, which we have for many years, and digital gold, which is what Bitcoin tries to represent. So we've done a tremendous amount of research on this. We're fortunate we have a resident expert. Our chief trader, Dan Zareli, has been researching and building his knowledge in cryptocurrencies and in Bitcoin for over a decade. And he's really helped us get up to speed, and we've done research since. And what I'll tell you is that I was quite impressed and have a better appreciation for the original design behind Bitcoin. Not only is it a clever technology that makes it work, the blockchain technology, but there have been some economic incentives that have been put in place that help the major constituents that help make Bitcoin work, incented to continue to make Bitcoin survive. And of course, nobody has a crystal ball. Perhaps regulators figure out how to shut it down someday, although that would be difficult. Perhaps someday in the future, a quantum computer is so powerful that it breaks the encryption that Bitcoin and other cryptocurrencies depend on. But again, that's quite far-fetched. But for now, we do think we need to pay attention to it. It could be a complement to gold. We don't see it as a replacement of gold, but it might be a complement alongside gold. And so this is something that we've done our research in, and we've begun to take some action in.
Excellent. And one thing I do remember reading is that it's been around since 2009, I believe, and there really haven't been any type of financial accidents or anything like that. So, I mean, that's a pretty good track record.
That's true, although I should say, and this is well known, that the volatility is tremendous.
Yeah.
And there are many times when people have invested in Bitcoin only to see their investment go down 50, 60, 80%, and then to go back up. And so we would be looking at Bitcoin not so much as a quick in and out day trade, but much more that if it turns out that enough of the investable world, including institutional investors, decide to allocate some portion of a portfolio to Bitcoin, we know what the total supply of Bitcoin will be ultimately. We can gauge what the market capitalization would be of the money that could come into Bitcoin. And so if it does continue to survive and institutions continue to increase their adaptation of Bitcoin, then we could see prices quite a bit higher than when they are today, but notwithstanding the volatility.
Excellent. Terrific. Well, very good. Thank you for all that insight. It does look like maybe this is the time for commodities to play a more important role in portfolios. So that'll do it for Steve and me, and we'll be back next week with another edition of the 3Edge Week in Review. As a reminder, all of our videos are available on our 3Edge YouTube channel and on our website, which is 3edgeam.com. Please feel free to subscribe to our videos, and that just means that you'll get notification as we produce videos in the future. And so now, on behalf of everyone here at 3Edge, we urge you to have an enjoyable President's Day holiday. And please stay safe, stay strong, and keep the faith. And thanks for listening.